Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton with PassiveInvesting.com. With us today, we have a special guest, David Kamara. Welcome, David.
Thank you, Whitney. It's great to be on your show.
Yes. I'm so excited because we were chatting a little bit before the show. I'm really excited to talk about this deal. But before we dive into the details of Lynden Park, that 154 unit complex in Ann Arbor, Michigan, tell us a little bit about yourself, how you got into multifamily investing, and where you're at now.
Sure. So I am David Kamara. I got into real estate kind of on an accident, at least multifamily. The original goal was buy a house a year and kind of keep them going. Along the way, I was a management consultant and traveled a ton across the country, helping a lot of people make a lot of money, and started missing my family because I was gone a lot. So my wife and I talked about how do we keep me home a bit more. Really was spurred by a question by my oldest daughter at the time. And we said, this single family thing kind of works, but needs to be much more scaled up. Let's try that. And so that's the short story. We bought an apartment complex for ourselves. It worked and we kept going. And along the way, some people said, we trust you. You're a smart guy. You have a system. We want real estate exposure. Why don't you manage our money? To which we said no for a while, but then finally we said, we'll try it. And it's worked so well so far. So we kept going.
Fantastic. I love hearing that evolution story, right? Continuing to trade up assets, like playing, a little bit of Monopoly, right?
Yep.
Well, let's dive into the details of Lynden Park. Again, 154 units in Ann Arbor, Michigan. You closed it, October 2022, correct?
That's right.
And so let's back up that timeline a little bit. Tell us how you found the property.
Sure. So last year, as you know, and your listeners know, right, interest rates moved quite a bit and the environment changed throughout the year. We did 6 deals last year, which is a lot for us. We don't do that many transactions, but we were working on a purchase in Iowa in April, May timeframe when this deal kind of took off. So the evolution of this deal was my property manager, who's my partner on number of our deals, introduced me to friends, partners, investors of his that were looking at this deal almost 18 months ago. So Chris and Kevin, local Detroit entrepreneurs. Chris owns an HR recruitment company. And I think he was looking for some tax breaks, right? And he knew some people that invest in real estate and he was like, hey, we should look into this. So they were looking to buy something. Kevin found this deal. Kevin is Chris's cousin. He found this particular deal is off market. And, it's 154 units, it's a lot. So they brought it to Justin to manage and said, we think we may need to partner on this. And Justin said, essentially, let's partner with David on it. So we spoke to the seller. We made them an offer. This was 2021 at this point, so summer of 2021. And the seller was a massive operator of multifamily. They own 33,000 plus doors. And they were honest about it. They're like, listen, we are very busy. This is not top of our priority list at this time. And frankly, we just can't focus on it. So thanks for your interest, but we don't have the bandwidth at the moment. So we said, all right, great. The deal was not listed. Kevin made a relationship with one of the brokers who essentially serviced the portfolio for these guys. And he knew that they were looking to sell it at some point, but again, timing wasn't right at that point. So like I said, we submitted an LOI, 2021 summer, didn't go anywhere. We moved on. We're doing other things. So then last April, this came back. And of course, interest rates had moved significantly between when we first submitted the LOI and last April. But it looked like the seller was more willing to talk. And we said, we'll just honor the LOI from the previous year, even though it's a much worst deal for us, given the interest rate scenario at this point in time. In any case, long story short, they took it seriously, said, sure, let's talk about it. And I think we had a signed LOI end of May, or signed PSA end of May. The difficulty, or the complication, or the fun part of this deal was my sister is getting married last summer, and this was pre-planned and known well in advance. And she was having a wedding in Italy, of all places. And so in the PSA, I essentially told the sellers, like, hey, I'm not going to be very actively working on lenders or frankly anything for the month of August. So I'll need a few extensions in this deal. And of course, at first they said, you know, if that's what you need, the deal's not happening. I'm like, we're fine with that. That's okay. I'm not going to work on this deal. Yeah, it's just not going to happen. Mm-hmm. So what we did is we wrote into the PSA 2 extensions of 30 days each, which is not regular, as most people know. And the compromise was, for each time we requested the extension, we put 100K hard, which the seller said, okay, fine. At that point, we'll be okay with that. So we signed the deal, like I said, end of May. We had a 15-day due diligence. This property is literally a mile and a half from my house. I drive by it every day, taking my kids to swimming. The diligence was great. Like, there was nothing, no red flags. The building is
well. Like, before we move off the diligence, I want to make sure we have like the timeline buttoned up for everybody. So sure. Because this is really unique, right? The property came on your radar in summer of 2021. Correct. But it was a no-go, right? So it was almost a full year later, or 10 months later, when this LOI that you originally put out there in 2021 comes back to you. And what I find really unique are 2 things. One, you had somebody in this relationship team, the property manager and one of the brokers, that was continuing to stay in contact with the sales team. Right? That's amazing, right? Like, I know deals come back around, but usually it's a really short window, like 2, 3, 4 months, not 10. So, and that you guys were able to kind of lock it in still at the previous terms that you were looking at, even though now you got to go through due diligence and kind of get everything in place. And that the seller was willing to work with you for your life circumstance that you had going on. Okay. And that's awesome. Now, if other people have those type of circumstances and they're putting it in their PSA, I haven't heard of that, right? It's not being disclosed, but there's so many things about this that are amazing. So it goes under contract, you have the LOI, gets approved, you put it under contract, and in May, you're telling the seller you're going to be kind of off the grid most of August. So you have a 15-day due diligence period and 2 30-day extensions. So end of May, that still gives you 60 days to close before you have to go to Italy. So walk me through the rest of that timeline and what happened there, or how, sure. And then we can get into like the due diligence and the lending piece.
Yeah, no, great questions. We were, like I was saying, we were closing another deal, a fairly large deal as well in Iowa at this point. So in April, we're working on this deal in Iowa, which was 136 doors, which was going to be closing mid-June. So again, we're raising money for that deal. That was roughly a $3.5 million raise. We closed in June. I have 4 kids. Kids are done mid-June with school. We're doing a bit of vacationing, visiting cousins in New England, etc. And at the same time, right, so when you're raising money for a substantially large deal, for us, this was a pretty large deal.
What was the purchase price?
Purchase price was $18.75 million. We were looking to raise somewhere in the neighborhood of $6 million, depending on where interest rates landed and what we needed for reserves. So partly why we decided to not close before August is because we thought we'd need a bit more money, a bit more time to raise the money, especially since we had just raised a significant amount of funds for the Iowa deal, and we'd just done a few deals before that one. So just trying to make sure the well didn't dry up too soon. So that was one reason. But then just again, my sister's wedding was end of August, but I was taking my whole family, including my parents, to Italy for pretty much 3.5 weeks. And that was supposed to be a fun trip. Didn't want to have to work banker hours and not get much sleep and really not focus on having fun. So those were the main reasons. And like I said, the seller did push back, but we said, listen, we are going to put earnest money down hard after we walk through the units. And for that reason, we did the 15-day diligence, which is fairly short, right? So we said, I mean, we're not trying to waste your time, right? So we are serious, and we're willing to show that by putting earnest money hard, which was $100,000 hard, after the 15-day diligence expired, which we went through with, and we said, yeah, I mean, there's no surprises. We walked through all the units, we reviewed all the documents. We're good, and here's our money, and it's hard, right? And the way that we work is we fund all of that ourselves. So we at Cape Sierra don't get investors to send money in early, right? And we don't have a fund. We raise funds for the specific deal. So essentially, we're taking on that risk, right? And so, I mean, I'm telling the broker, I'm telling the sellers, like, you know, we are not Blackstone or Carlyle or one of these big PE firms that has real estate division that has funds to write. These are, I mean, that money means a lot to us, and it's personal funds. So if I'm willing to do that, I am pretty serious about a deal, and I've never lost money like that on a deal, and I don't intend to start now. So we did that, walked through, diligence was fine. And then started talking to
Did you do the walkthrough after you had it signed, a signed PSA agreement, or did you do any sort of site visit beforehand? I mean, it's right next to your house.
Yeah, no. So we did a site visit right before we had the deal under contract, which was, we saw 2 units, right? It wasn't much. But then once we had a signed PSA, then we walked all 154 units, which is what we always do on any property we purchase. And of course, all the, get environmental inspection, get your PCNA third-party reports, but also we had roofers come out, we had some HVAC folks look at it. The property is very unique. So if I could talk about that for a second, the whole deal thesis is the property was built in the early 2000s, and it was built as a low-income housing tax credit project, which in Michigan, at least, most of these expire in 15 years, and you have the opportunity to either re-up for 30 to 99 years, or at that point, if you can go through the process and get them out of LIHTC, then they can be market rate. The unique situation here was the seller had already done this work, and they'd already taken the property out of LIHTC, which is a bit of a process. You have to go through and work with Michigan's housing authority to make sure that you actually list the project for sale at whatever purchase price they determine with the tax credits that have been given to the people that built the project. Usually nobody purchases it at that price, and if nobody does, then the state says, okay, you have the go ahead to take it out of this classification. So they had done all this work, and the property was no longer low income classified, but it was still being kind of run at lower rates, so the rents were still lower. Further, it was also built as a 55 and over property, and that classification had lapsed, right? And so legally there was nothing preventing anybody, including the current owner at the time, from just running it as a market rate property. But again, like I mentioned earlier, they were a larger operator, not based in Michigan, they were national. And it just seemed like this was not a priority for them. They weren't trying to squeeze all the juice out of it, per se. So just looking at the current rents, they were about $300 under the market, right? And the work to do that would be to, yes, there's some minor improvements that we needed to do. But I think the bigger task was to just put your foot down and say, we're running it as a market rate property, and over time transitioning tenants to market rate, which was our business plan, right? And so that gave us a lot of comfort that there was a lot of value in this deal. Further, as part of our diligence, we walked through about 10 complexes within a 2-mile radius of this and looked at, what are the amenities, what are the finishes, what are the rents, who pays for what, utilities, how are they structured, which again, further gave us a lot of confidence that we could accomplish what we wanted to accomplish.
Awesome. Yeah. Okay. So there's an opportunity there with those two different classifications running now and scaling up your business plan as you, are underwriting the financials. Now, you put it under contract NMA. That LOI is already more, not looking as the financials are not looking as good as they did the summer before when you originally were looking at the property. You go through the summer, interest rates are rising. Tell us let's talk a little bit about the financing. What kind of financing debt did you put? You're smiling. For anybody's listening to this on the podcast, David's like nodding his head and smiling. Let's talk about that financial piece. What did that look like?
Yeah, so that was definitely a challenge and something we thought through a lot, right? Interest rates pretty much rose about 2 full percentage points last year. And that's being kind of generous. I think there was more than that. But so originally, we knew that we wanted to spend some money on the property, specifically the business plan for CapEx and renovations was to remove carpet and put in vinyl plank floors. The cabinets and finishes were original from about 20 years ago when the property was built. So some were still fairly decent, some were needing to be replaced. And so we put in a CapEx budget of about, I think it was $7,000 to $10,000 per unit in terms of cabinet replacement upgrades and countertop upgrades, paint, and like I mentioned before, floors. So we were speaking to various vendors, various lenders to see what options were. What we ended up with was we believe that in a fairly short period of time, 2 to 3 years, we would be able to raise rents to market, right? With operating it as a market rate property, but also doing these CapEx improvements. And so the discussion or the thought process really was, do we take, fixed interest rate debt for a long time and lock it in? The advantage there is you're not playing the interest rate game and you don't know where interest rates will end up and how that will go with the Fed, with inflation and all of that. The disadvantage of that approach would be you get a massive prepayment penalty if you wanted to take out, your cash and return funds to investors. And so what we landed on was the flip side, or the other option available in terms of loans would be take a floating interest rate loan, which is clearly risky in that environment, but it gives you the option of an early exit of that loan and a refi into something permanent, at which point you're capturing the value you have added in 2 to 3 years. And so that's what we opted for, right? So we debated that for a while, talked to various lenders on both approaches for a while, and the numbers seem to work better if we captured the value that we would add to the property in 2 to 3 years. Again, right, just because of how the calculations work, right? If you can raise your NOI fairly quickly, then the property is worth significantly more. And roughly, I guess, so we bought the property, we had in the contract for $18.75. With our projections, the property would be worth close to $30 million within 3 years or so, roughly, based on what we plan to do to it. So, of course, capturing that additional $10–11 million made more sense, or brought more value to the table, and that's why we opted for it. In terms of the risk mitigation on interest rates, the thing to do here is go by an interest rate cap, right, to cap your downside or the upside risk of interest rates going much, much further. We did some calculations on that as well, and we have done caps on similar loans before. The issue became that as inflation continued late last year, and as the Fed continued raising rates, there were various forward-looking curves on, what would interest rates peak at, when, how, but also because of the uncertainty, the cost of buying an interest rate cap was astronomically high. I think we got a quote for something like $600,000. And at that point, the cost benefit did not make sense. So we decided to not buy an interest rate cap on this deal, mainly because the thought was that while interest rates would be raised aggressively by the Fed last year, which they were, the thought also was that this year in 2023, the pace of rate increases would ease and hopefully stop at some point. And at some point that curve would dip down a bit. Of course, no guarantees, but we made that bet and we think that we made the right bet.
And so it was, I take it, okay, so you had a floating rate loan, no cap. And what, did you have any lockout periods or prepayment penalties on this?
Sure. So the numbers are, so the purchase price is 18.75. Essentially, a loan is for 15 million, of which about $1 million is capex. So we got funds of about 14.1 or $14.2 million to close, and about $1 million in a capex reserve that we can draw on. Of course, you only pay interest on the capex once you use it, right? So essentially, the loan is for 14 million until you use the rest. The interest rate was a 30-day SOFR average plus 5.5 percentage points, which I think today SOFR 30-day average is about 4.4. So our rate as of today would be 9.9%, which is expensive on $14 to $15 million. The lockout period was roughly, I think, 18 months. So we could transition out of this loan in 18 months without any prepayment penalties. Did I miss any other details that you asked?
No, I guess, how did you underwrite this into your financials? Because you have two very different interest rate environments when you're originally looking at this deal and then what you ended up purchasing at. Like, how did you adjust your financials? I think that it would be a question that listeners would want to know.
Yeah, so
most people would walk away, right, if they saw this type
yeah,
of
so the big question was really two big questions, right? One big question was, how comfortable were we that we could raise rents to market in a fairly short period of time? So this is where having a property manager that you trust and believe in makes a massive difference. And we work with MTH Management here in Michigan. They're based in Lansing, awesome group, family business, and we've worked with them for about 5 years now. They manage over 5,000 units in Michigan and other states. I think they're in Louisiana and Iowa where they manage for us. And I really trust their judgment, right? And we walked through the units together. We did the other side surveys together, and we had long conversations about, in this market, in the Ann Arbor market, the property is actually in Pittsfield Township, which is one of the suburbs, but the school district's Ann Arbor schools. Can we get to roughly, at this point, we were looking at $1,300 rents on average. And the current rents for the property were just below $1,000 a unit. We thought we could. We thought it wasn't too much of a stretch, and we ran some sensitivity analysis about what would happen if we fell a bit short of that and what would happen if we fell a bit above that. So that gave us some comfort. Secondly, the second big question was, of course, like, what would interest rates go? Where would they top out, and how would that work? The way that we structure our returns to investors is we don't have a preferred return. We just have an equity split. Our GP is 30% and cash investors get 70%, and we invest our own cash into the deal as well. Between the GP on this particular investment, we invested almost $1.4 million of our own cash into the deal. And I mean, I think that pretty much speaks to anybody that we believe in the deal, right? That's a pretty good size chunk. I think we essentially, personally, I put in over 17% of all the capital we raised into the deal, right? We ended up raising 6.2 at the end of the whole thing. So the question was, if interest rates exceeded our projections, we ran some sensitivities about, okay, if interest rates go to 10% total, how does that look? If they go to 11% total, how does that look? And if we go to 12, what does that look like? And we figured that essentially, if we get to 12% interest rate all in, which right now we're like 9.9, I think, the deal would still work because a good chunk of that return comes from the value add of what the property is worth, right? It's not a cash flow play. But because we on the GP side own a significant portion of the deal too, essentially our fallback would be we wouldn't pay ourselves and we'd pay our investors, right? So that's how we rationalize that, we felt like the risk was still overall low in terms of what would this building be worth in 5 years. Like that was not a question we had much trepidation about. We were pretty confident that it'd be worth in excess of $30 million, which is kind of our target for the renovations, which could be much sooner. The real question was about, are the cash on cash returns going to be fulfilled, and what is our buffer to get investors some returns, even if we fell short of what we projected when we initially underwrote the asset.
All right. So I think this, because a lot of people that I that come on the show and talk about their deals, they're doing kind of the exact same type of deal structure, some sort of preferred return, some sort of back end split, 80-20, 70-30. What's unique about this deal is that it's just the one split, right? Correct me if I'm wrong. And this is, a good indication of if you're looking at a deal that might be more an equity play than a cash flow play. This is, there's some great points that you bring out here on lessons learned that somebody can take and, utilize in their own deal. So I love that. What kind of fees did you guys charge on this deal?
Yeah, so we're a bit unique in how we structure our deals. We do a 2% acquisition fee, and that's pretty much it. So we do a capital event fee of 1% if and only if the net returns to investors exceed a 15% average annual return, right? So if we refinance in whatever year, and with that refinance, the returns to investors exceed 15% annually, then we charge that fee. If we don't exceed that, then we don't charge it. It's essentially like a success fee, right? We don't charge an asset management fee, which is very unique to us. Something that we're evaluating whether we can keep doing, because everybody charges an asset management fee. And there's good reason to charge an asset management fee, but when essentially I started my business, all investors hate asset management fees, right? It detracts from the return. And again, our investor alignment usually is we get paid in equity. So if you, the investor, do well, we do well, and we try to minimize fees. So again, on this deal, there's no asset management fees. There's a 2% acquisition fee, which was essentially for doing all the work in the diligence, trying to find the investors, trying to structure the deal properly, just making it work, which again on this size deal is a good size dollar amount, but definitely we feel like it's worth the value we bring and the value we bring to investors.
Awesome. All right, let's talk about takeover. This is a question I started asking because not all the bumps in the road actually occur during the due diligence period and the closing period. Sometimes the big bump happens a couple weeks after closing. You have the property and you uncover what you didn't uncover during due diligence. So tell us about taking over the property. Did any issues come up throughout that initial, say, 2 to 3 week takeover process?
No. So actually it was fairly smooth. I mean, we transferred utilities over, we transferred management, we worked with the sellers, I mean, in the weeks before close to let their team know if we would be hiring any of their team or not. We ended up hiring a new set of staff. We retained one of the maintenance personnel who's stellar and has been doing great work since, and we like him a lot. But in terms of takeover, things have been fairly smooth. When we bought the property, there was one vacant out of 154 units. We did not rock the boat much because we're again going into winter, so we didn't come in and do any massive rent increases, right? So for units that became vacant, we did some minor renovations and put them on the market and got actually very, very decent rent bumps, very, very similar to what our deal thesis had dictated, about $200 to $300 rent increases without doing anything too major. And we just wanted to take over make sure we understood the tenants, make sure they understood us, and kind of learn about the property before we started doing too many new things. That has been great to date. So really no major speed bumps on that front. It's been great. And again, it speaks to the testament of the kind of property management company we have. And typically our takeovers go smoothly. Sometimes you find things in diligence, or you don't find things in diligence and you find them in the first few weeks of ownership. We had, I think, one other property where, interestingly, the gas had to come be shut off. And we're like, wait, what's going on? Like, yeah, this building seems like there's a leak. We're like, how? What happened? But
We were just here.
yeah, on this one, it was very smooth. No issues at all.
Awesome. All right, well, let's wrap up. On this deal, did you find anything easy, or did you find something that was easy that you thought was going to be more challenging? And was there something that was more challenging that you actually thought was going to be easier?
Okay, so things that were a bit more challenging than we expected on this deal specifically were working with the seller. Again, the seller was large, corporate, anonymous, and essentially the negotiation was through the attorney, which, I mean, was a bit contentious, but we ironed those things through. Of course, the larger, the more sophisticated the seller, the more clauses and requests they have for how you treat them during the sign to close process, which was fine. It's just a bit more marred in bureaucracy than we like or tend to see, but that happens and is fine. Things that, I mean, I do have to say, like the raise was a bit challenging because I think we just raised a lot of money for us this past year. I think in last year, 2022, we raised about 15 million total for all of our deals. And we don't really work with third-party money raisers. We just raise through our network, and most of it is people that I knew in my past life through work and consulting and clients and so on, and a lot of introductions of just people that have trusted us over the years. But I think the well was getting close to dry. And I think frankly, it was a difficult time to raise funds for real estate because of the interest rate environment, right? Because a lot of people came on and were like, well, you know, I want to do this, but I think I may just sit on cash for a bit. And you can't just say, well, you know, your cash is going to be worth less next month because inflation's happening, right? And it's going up. And I mean, like you can't tell people that because, again, it's their money. They don't owe it to you, and it's fine. I mean, you just can tell them why you think it's a good deal. I think people had reservations, legitimate reservations about just timing, and is this the right time to invest more in real estate, right? Especially if you compare rates were at 3% early in the year. Now they're at, you know, 6, 7, 8, 9%. Like it's a good legitimate question. So for that reason, I think it was a bit just the tail end of the raise was a bit more difficult and more challenging than we had anticipated, but again, came through just fine. And on this deal, we had Chris and Kevin and Justin that also chipped in the raising. So that was good. Things that were easier than anticipated. I think post-close, I mean, like you mentioned, things have been very smooth. Our occupancy has been above 97% for the entire time we've owned it so far, which is good. We are starting to do some more renovations as we head here into spring. And so we'll see how those are received. But again, to date, all the units we've turned and that we've put money into have definitely performed and met expectations.
Awesome. Well, David, thank you so much for sharing your expertise with us and your insights on this property. If listeners want to find out more about you and follow you, where can they do so?
So our website is capesierracapital.com, which is a nod to Sierra Leone, which is where I'm from. So CAPE, Cape, Sierra, SIERRA, Capital, CAPITAL.com. While you're there, you can check out our ebook. It's the cash flow formula, the personal cash flow formula, which is at Cape Sierra Capital/cash flow.
Awesome. Well, David, again, thank you for spending the time here with us today. We look forward to hearing about your future deals.
Thank you so much, Whitney. I really enjoyed it. Thanks a lot.